Nancy from Nancy Chu Homes at Keller Williams NJ Metro Group. Okay, so this is my last post of the year, and I'm going to end it on a bang with something super dry. I'm going to introduce you to the Federal Open Market Committee, FOMC. These are 12 people who have an extraordinary amount of effect on your lives, and you probably don't even know it. Okay? There are 12 people 12 voting members who consist of a chair and 6 other governors that are appointed by Congress, and a vice chair and 4 other regional Federal Reserve Bank presidents. And their main goal as a committee is to maintain maximum employment by controlling unemployment and to keep prices stable by controlling inflation. Now, as you know, inflation's been a real hot topic lately, so let's talk about why. The FOMC affects you because they control the federal funds rate, okay? And this is a rate that the banks use to guide them on all other interest rates, okay? So now, as a result, the federal fund rate controls the availability of money to invest in homes or businesses, and ultimately they may affect your salary, your investment returns, your retirement portfolio, and ding, 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 the cost of your next mortgage, okay? So now you know how it ties into us and real estate. Now, in the final meeting of 2021, which they just had, the FOMC basically announced that they're going to slow down and eventually stop their bond purchases and their mortgage-backed security purchases. Now, this means that the goal is to stop emergency quantitative easing by spring of 2022. It's a little faster than I think we thought they were going to move. Okay, so you're probably wondering, what is emergency quantitative easing, okay? So 2 years ago, the Fed started buying treasury bonds and mortgage-backed securities to try to help the economy through the pandemic. Emergency quantitative easing, okay? Now, the plan is, after they stop buying treasury bonds and mortgage-backed securities, they're going to slowly start raising interest rates, okay? Now, why? Well, because inflation is currently at an all-time high in the last 4 decades. It hasn't been higher in the last 4 decades, and the unemployment rate has kind of gone back to pre-pandemic levels, which is pretty darn good. Now, you have to understand, the Fed really got caught off guard about inflation. Across the board, everybody was like, it's not that big a deal. They did not expect, I'm sorry guys, this particular post has a lot of acronyms in it, but I'll take it slow. They really didn't expect the Personal Consumption Expenditures Price Index, which basically measures inflation on food and energy costs like, electricity and like automotive fuel, for instance, okay? They didn't expect to go past 2% this year. Well, instead it went up by 4%, which is double what they thought it was going to be. So that's why they started to get really uncomfortable. Now, the Consumer Price Index, right? That also rose by 6.8%. Now, the Consumer Price Index pretty much indexes all the other things, all the other consumer goods and services that people pay for. A 6.8%, you guys, you must understand, inflation has not been this high in 40 years, and people are starting to kind of freak out. So now, if you take this information, right, the high inflation, and you couple that with super low employment rates, this usually means that there's going to be an interest rate increase, okay? This is what they've proposed so far. 3 potential increases in 2022, 3 potential increases in 2023, and 2 more in 2024. Okay, let me backtrack a little. Please remember, this interest rate hike that we're talking about is not the interest rate hike that you pay directly on your mortgage, okay? It is one that the bank pays when it borrows money. Okay, so do you remember the thing we were saying about the quantitative easing? Now, for the last 2 years, as part of these emergency measures to keep the economy buoyant or strong, they have kept this benchmark lending rate at almost 0%, okay? So that money is super cheap for banks to borrow, so that they in turn will pass that savings onto the consumer. by keeping credit card interest rates lower, small business loan rates lower, personal rates low, personal loan rates low as well. But once they stop buying bonds and securities, then that really starts to put the pressure on mortgage interest rates too. Now, honestly, we've already seen a reduction in refinances. It could be about the interest rates ticking up, or it could just mean that everyone who was going to take advantage of the low interest rates to refinance kind of did it already. I mean, it was kind of a run on refinances the past couple of years. Listen, so what does this all mean? Okay. Low inventory, which we all agree at this point. We all agree. Let's just be on the same page here. Inventory is low, like super low, okay? Inventory is low, which means that home prices are usually higher. Now, we couple that with higher interest rates. What does this mean? If you want to get into a house in the next 2 years, you better start looking now, because I'm going to tell you, you could easily become priced out of the market for the home that you thought you could get. That means that you have less buying power, which means that you might end up with a house that's smaller than you thought you could get, or a house that was older and needed more work, or a location that you didn't want as much as the location that you'd hoped you would get. Look, they're going to be careful. Do not get me wrong, okay? If inflation kind of like adjusts itself down like naturally, which could happen, by the way, if COVID affects our employment numbers again, look, then I don't know that they're going to fit in all 8 interest rate hikes that they want to do, okay? They're going to be smart about this. Whether the Fed or not can achieve, whether they can or cannot achieve their goals over the next 3 years, a lot of this is going to depend upon, how we react to the pandemic, how quickly life goes back to normal, all these things. So here's my take on this, which is, if you're looking to purchase a house, or if you need any advice about real estate, it's really time to have a very serious conversation about it, okay? Before your options become limited. All right, this is my last post for 2021. It's been super great. I'll see you guys back here in January. I really look forward to it. And by the way, if you have coats to donate, we still are taking coats. We're going to be taking through the end of the year. So you can always reach me. 917-992-3098 is my direct cell phone. You can always find me at Nancy Chu Holmes on Facebook and Instagram. All right, I will talk to you guys soon, and have a happy, happy new year.